North American trade dynamics have been significantly altered following a strategic economic move by Canada at the beginning of 2026. Discarding its historical reputation as a patient, predictable, and accommodating partner that often operated in the shadow of the United States, Canada has taken a calculated step that is redefining its relationship with its southern neighbor and reshaping modern trade conflict strategies. This action, executed without loud announcements or dramatic political escalation, focuses on economic leverage rather than rhetoric. For decades, the bilateral relationship, while beneficial, maintained an imbalance where Canada was frequently treated as a convenient extension of American economic needs, with Canadian resources flowing south at prices favoring U.S. industries. Even when faced with tariffs and disputes, Canada's traditional response was measured and restrained, creating a global perception that it would absorb pressure and adapt rather than confront. This perception was reinforced when then-President Donald Trump suggested Canada could become the 51st state, a remark reflecting an assumption of Canadian autonomy as a matter of convenience, which the world largely expected Canada to endure. That expectation has now been disrupted by Canada's decision to actively utilize its structural economic leverage. The core of this geopolitical shift lies in a technical adjustment to the export pricing of softwood lumber. Executed quietly within the existing trade framework, this move bypassed the need for new retaliatory tariffs while immediately impacting a sensitive sector of the United States economy. The strategic nature of this decision is underscored by the structural dependency of the U.S. market, which relies on Canada for approximately 1/3 of its total lumber consumption. In border regions, this dependency is even more pronounced due to geographic proximity and transport efficiencies. American domestic production has remained unable to fill this gap, constrained by mill closures, regulatory hurdles, labor shortages, and high capital intensity. Consequently, when Canada raised base export prices, it effectively amplified the cost of existing U.S. anti-dumping and countervailing duties. This maneuver shifted the economic burden of trade friction away from policymakers and directly onto American households and businesses. The consequences manifested rapidly within the U.S. housing market. As lumber is a fundamental material for residential construction, price increases forced builders to either absorb reduced margins, delay projects, or pass costs to consumers. By early 2026, smaller construction firms began postponing developments and rewriting financing assumptions, further straining housing affordability. The impact extended to furniture manufacturing, prefabricated construction, and interior finishing industries, where tight margins left little room for cost absorption. Employment sectors tied to construction and logistics also saw reduced work hours and contracting regional networks. Because the U.S. lacks a short-term substitute for Canadian softwood, given that new mills require years for permitting and investment, the economic shock was absorbed internally. This highlighted a significant contradiction in U.S. trade policy. While tariffs were intended to protect domestic industry, they served to reinforce dependency on Canadian supply when no viable domestic alternative was available. By asserting this control, Canada has transitioned from a price taker to a price setter, signaling a move towards strategic economic sovereignty. The long-term implications of Canada's strategy extend beyond immediate market volatility, signaling a fundamental shift in how resource-rich nations exercise power. By leveraging softwood lumber, a foundational physical input that cannot be easily digitized or replaced, Canada has exposed the limitations of traditional trade tools like tariffs. While the United States may consider political retaliation or further investigations, such measures risk driving internal costs higher without addressing the underlying supply deficit. Expanding domestic U.S. production remains a multi-year endeavor, hindered by environmental regulations and labor constraints, leaving the current bottleneck as a permanent point of Canadian leverage. This recalibration serves as a global signal that reliability is not synonymous with passivity. in that control over essential supply chains is becoming a defining factor in modern economic sovereignty. However, this shift carries inherent risks that the Canadian government must manage to maintain its strategic advantage. Potential U.S. diplomatic pressure and narrative framing in American media could characterize the move as opportunistic, testing Canada's reputation as a rules-based partner. Furthermore, short-term demand fluctuations and internal pressure from various Canadian economic sectors require careful policy alignment to ensure domestic stability. Despite these challenges, the move sets a precedent for the next generation of trade, treating resources as strategic assets rather than mere commodities. As global markets and multinational corporations reassess their risk models in response to these structural changes, Canada has demonstrated that influence in the 21st century is increasingly derived from the disciplined management of physical supply chains. The outcome suggests that power in the global economy does not always require loud confrontation, but can be effectively asserted through the calculated adjustment of pricing and the management of structural dependency. Subscribe for more fact-based global analysis.